Right, hello and welcome, or welcome back, hopefully, if you've been joining us for previous webinars that the BBA is conducting. This week is UK Construction Industry Forecast 2022. Delighted to be joined by Professor Noble Francis. Professor, welcome.
Thank you very much. I was just on pause there, on mute there, sorry.
No problem. So I'm just, before we get to the insights and all the valuable goodies that Noble's going to share with us, I'm just going to run through a couple of BBA elements and a few slides, which if you've been on one of our webinars before, you'll be fully aware of these, but let's do them nonetheless. So the BBA has been up and running for over 50 years. Helping construction and the manufacturing industry build confidence in solutions, designs, creations, and implement them throughout the entire supply chain. The BBA also looks to develop long-term partnerships with clients and associations, such as the CPA, and this is for continued growth both in the UK and in global marketplaces. But it's important to remember that the BBA will always remain reassuringly impartial. Final part on the intro to the BBA is the BBA is actually a for-profit organisation limited by guarantee. So what the BBA does is look to reinvest in the industry as a whole for the benefit of everybody on this webinar today and the wider stakeholder community within construction. But what do the BBA actually do? So the BBA are mainly known for their PAC, their Product Approval Certification. BBA Agreement Certification. I'm pretty sure most of you, if not all of you, have heard of that, as well as reproduction and HAPAS. But we also do other elements. We do testing, product testing, audit and inspection, management systems, that's your ISOs and the likes, and more recently focusing on UK CA marking and UK TA conformity. To date, we've issued over 6,000 certificates and done over 1,000 annual inspections. I'm clearly going to focus on the big numbers on this slide and why the heck not, but there's a few of the numbers there that you can digest for a couple of seconds while I rabble on. Anyway, that's enough of the BBA. That's what we do, that's what we're about. But today is more about looking towards the future. So what we're going to cover is a UK economy update, latest construction data and forecasts. We'll look at key risks, challenges and opportunities, and you will also have your own opportunity to ask Noble your own questions. If you have any, please use the Q&A functionality that comes with this webinar, and we will get to those questions at the end. If we don't have time, I promise you we will find the answer and we will get back to you after the webinar, but obviously time constraints sometimes get away from us. So that's enough from me. Without further ado, I'd like to give Professor Noble Francis centre stage and welcome once again. The floor is yours.
Thank you very much, and thank you to the BBA for inviting me to speak. My name is Noble Francis. I'm Economics Director at the Construction Products Association and Professor of Construction Economics over at UCL Bartlett School of Sustainable Construction. And I'll get into the economy and construction in a minute, but it's worth highlighting that in my 15 to 20 years of doing construction forecasts, I don't remember a time like this in which demand in some parts of construction is very high. And so we're in a relatively buoyant situation within some sectors and some regions. But there have been so many risks on the supply side and so many different issues as well. And what I'll try and do is focus very much on those because it'll give you an insight into what may be coming down the line and what we're currently facing at the moment, given that as a construction forecaster, generally you tend to spend 90% of your time on demand. You're generally looking at what projects are in the pipeline, what contracts have been ordered, what contracts are going into planning. You're looking at the early indicators of demand as well. But actually, over the next 12 to 18 months, the biggest issues are whether we actually have the capacity to do everything that's in the pipeline. So what I'll do is I'll just have a couple of slides on the economy, give you some sense of where we're thinking for next year and some of the key risks around the economy. Then I'll get into the latest construction data and then get into our construction forecasts, then highlight those key risks I was mentioning. So if we just move on a couple of slides and get on to this chart, which highlights UK GDP, and the black line highlights the GDP we've had on a quarterly basis since pre-COVID. The red dashed line shows that pre-COVID level of GDP. And clearly in the first quarter of last year, we're just entering that initial lockdown, which is clearly what had the biggest impact upon the economy. The second quarter is where we really face the nadir, because it was the full impacts of the initial lockdown which affected all sectors: construction, manufacturing, services. And so we had a big dip in GDP. Quarter three last year, we had a very sharp recovery because we reopened, we got back into summer, a return largely to normality before we faced the inevitable second wave in autumn winter time. And so we had a second national lockdown in November last year, and then we had a third national lockdown in the first quarter of this year, which led to a dip in GDP that you can see at the start of 2021. But that dip is nowhere near what we faced during the second quarter of last year, because some sectors, such as construction, were allowed to continue. In addition, other sectors, such as manufacturing, continued, and even sectors like services had a greater degree of working with the social distancing restrictions. So you could have takeaway, you could have other forms of working, click and collect, click and deliver as well, which helped services. But we did still have a dip in the first quarter of this year. The second quarter of this year, we had a sharp recovery again, because you're literally just reopening parts of the economy. So it's a very sharp recovery in the second quarter of this year, where GDP rose by 5.5%. The problem is what happens going forward, because the second quarter of this year, you get those quick wins for reopening the economy just by reopening things. We're not going to be able to have those now. And so GDP growth from Q3 this year onwards is going to be based upon effectively real growth. And what you notice overall is that what we have for the UK economy is a W-shaped recovery because of that initial dip in the first national lockdown, then the dip due to the second and third national lockdowns, and then recovery afterwards. But the blue-grey line shows our forecast going forward. And what's noticeable is that after these quick wins of reopening the economy, we still have growth going forward, but at much slower rates. Overall, this year, we're anticipating GDP growth of 6.8%. And next year, we're expecting growth of 5.5%, which is significantly lower than we were expecting in the summer. We were expecting, back in our summer forecast, that GDP next year would rise by 6.3%, now only 5.5%. So we've revised that down significantly, and that's largely due to the key risks that are out there. And that's on the next slide. So the key risks are rising and have risen significantly over the past 3 months. terms of our key risks, we had what happens to unemployment now that furloughing and the self-employment income support scheme have ended. The furloughing scheme has been incredibly successful in maintaining employment, particularly within the services sector, but also it's been used from the construction sector and manufacturing. And as recently as September, we had 1 million people across the economy still on furlough. Now that's ended, what will happen to unemployment? From our perspective as the CPA, we're anticipating that now that the furloughing scheme has ended, we won't see a significant rise in construction unemployment or manufacturing unemployment. And the reason for that is that as we came towards the end of the furloughing scheme, we had record numbers of vacancies in manufacturing and construction because activity was relatively buoyant. What we may do is see a slight uptick in unemployment within certain parts of services, which is areas in which activity hasn't recovered back to pre-COVID levels. So you're largely looking at tourism and travel and some areas of person-to-person interaction services. So that's cafes, bars, restaurants, in-store retail. Our second risk is around government tightening spending and raising taxes. It's very clear that schemes like the furloughing scheme and business loans that have kept activity going despite the lockdowns across the economy are expensive, and government is going to be looking at tightening spending despite all the headlines in the autumn budget and spending review of the Chancellor opening his checkbook. So what we're likely to do over the course of the next few years is see government tightening spending and raising taxes, but that's only really likely to occur from 2023 onwards. The government is going to be likely to wait until economic recovery has been sustained for a long period before it tightens spending. Will households revert back to normal spending patterns? Over the past 18 months, we've seen a big shift in household spending from traditional in-store spending to online spending. We've also seen spending away from non-essentials and towards a search for space, if you like. So moving towards renovation projects in their homes, which is outdoor, better quality space, decking, fencing, etc., but also indoor, better quality space as well, such as better home office facilities for those office workers that still are working from home, converting in a garage into office space or storage space. We've also seen increased housing transactions moving over towards houses with space as opposed to flats in urban centres, and that has been primarily in areas where affordability is greatest. So you're looking at Scotland, Wales, the north, as opposed to within urban centres such as London. Our key risk, which has risen sharply over the last 3 months, is based around the impact of rising inflation on economic growth. And that's primarily due to the increase in energy costs that we've seen over the last few months. There's a direct impact of those energy costs, which is to reduce household real disposable income. It reduces their consumer confidence and consumer spending. But there's an indirect impact as well, which is as those energy costs spread through the rest of the economy and increase prices across the economy, then you end up with a second round impact upon consumers. And the Bank of England anticipates inflation peaking at just above 4% towards the end of this year. We are anticipating inflation will peak above 4.5%, closer to 5% in the first quarter of next year, and it might be persisting for longer than that as well because of those second round impacts. That will impact upon consumers and consumer spending, which may hit GDP growth. And then a medium-term risk, which is the final bullet point there, based upon what will happen in terms of those workers that will still be working from home. We're assuming that in the medium term, office workers will get back to the office on average 2 to 3 days a week. For some, it will be more like 4 or 5 days a week if they need team interaction. But for other office workers, it will only be 1 or 2 days a week because they can work on their own, they can work on sole projects. But on average, office workers will be working from the office 2 to 3 days a week. But what does that mean medium term for the demand for offices? And not just offices, but support services, retail that is dependent upon commuters, leisure, and transport infrastructure, given semi-permanent working from home. Okay, so that's largely our thinking in terms of the economy. But if we move on a couple of slides, then we get into construction. And it's worth highlighting the latest construction output data. Whilst it's a W-shaped recovery for the UK economy, because it was affected by the initial lockdown, the second and third national lockdowns, it's largely a V-shaped recovery for the construction industry. And that's because it was badly affected by the initial lockdown, as you know, particularly in April last year, but it wasn't particularly affected by the second national lockdown in November and the third national lockdown at the start of this year, because construction could largely continue unhindered. There was a slight impact on productivity on site due to social distancing, but site operating procedures meant that activity could continue throughout the second and third national lockdowns, particularly on infrastructure sites where it's outdoor, where transmission of viruses is relatively low and social distancing is easier. Now, according to the Office for National Statistics, the construction output fell in July and August, which is largely in tune with what contractors have been telling us, which is that activity is relatively buoyant, demand is relatively high, but July and August, there was quite a few of their workforce taking holiday time that they built up over the previous year. However, the ONS also say that activity has dipped since March this year. And if we move on to the next slide, it's worth highlighting that we have some concerns about the most recent ONS data, and we are expecting revisions upward in the data for certain sectors. There is a clear difference between those sectors in which activity is relatively buoyant, infrastructure, private housing, repair, maintenance and improvement, and private housing new build, and those sectors in which activity remains relatively buoyant, relatively subdued, and those are industrial and commercial. What's noticeable from this chart, which shows the evolution of the key construction sectors since January 2020, so pre-COVID, is that infrastructure has recovered the sharpest and continues to go from strength to strength. That's largely driven by the main construction projects, the major infrastructure projects. Within infrastructure, the majority of activity in the sector is provided by the frameworks, but the growth, the large growth rates tend to be provided by the major projects. So you're looking at Hinkley Point C, the nuclear power station, you're looking at Thames Tideway, the super sewer, and you're looking at HS2. The concerns we have about the most recent data from the ONS and areas in which we're expecting revisions upward once the ONS has more recent and up-to-date data are the orange line and the green line. So private housing repair, maintenance and improvement, and private housing new build. And those are areas in which demand is relatively buoyant, but the ONS has shown that there have been sharp falls in activity since March, which is not reflective of what we find speaking to contractors. If we move on to the next slide, then it's worth highlighting that as a forecaster, we don't just rely on the data and the early indicators and the new orders information. What we've had to do increasingly is speak to firms down on the ground, whether it's architects, cost consultants, main contractors, SMEs, builders, merchants, and product manufacturers, because the data tend to lag by a few months, but we can actually get a greater sense of what's really occurring in the last few weeks, the last couple of months, from contractors down on the ground. And it's worth highlighting that from the firms we speak to, housing demand continues to be very strong, and that's despite some of the government stimulus like the stamp duty holiday having been tapered and then finishing. That's despite government stimulus such as Help to Buy being more constrained. And you see that housing demand continues to be very strong because there's still double-digit house price inflation there. But it is worth highlighting once again that the demand is very clearly for houses as opposed to flats. And it's very clearly in areas of the country where affordability is greatest. And you're looking again at areas like Scotland, Wales, the North as well. Most of the house builders say that demand is not just currently strong, but they're expecting it to be strong for the next 6 to 9 months as well. However, they do have medium-term concerns about affordability, which makes sense if you think about it, given that the sharpest recovery in demand within housing has been where affordability is greatest. But if you have 18 months of double-digit house price inflation, then those areas are not so affordable. In terms of private housing repair, maintenance and improvement, which doesn't get most of the headlines because it's lots of little projects around the country, but it's the 4th biggest construction sector, and it will become increasingly important as we move over towards doing retrofitting of the existing housing stock as part of net zero. Firms in private housing, RM&I, say demand remains very strong. Most SMEs, small, medium-sized firms, have projects lined up for around the next 6 months. The problem for them is the materials availability and cost. And that's not just on projects they're working on at the moment, but it also means from their perspective, it makes it incredibly difficult to price projects after the next 6 months. But at least from their perspective, demand is very high. In the medium term, there are concerns about what happens to demand if households shift back in spending away from that search for space and towards general spending on non-essential retail and leisure within shops and within cities, travel and tourism as well. But most households have been building up savings over the past 18 months, particularly those households where they've been working from home. And the Bank of England estimates that households have built up £200 billion worth of savings as a whole. So that should be able to fund spending on non-essential retail and leisure, as well as on renovation. But the bigger issue is what happens to household spending when inflation rises and when they find that energy costs are hitting them, once they find that consumer confidence is slowing because of that higher inflation next year. Will they still be happy to do renovation projects that will cost more? Public housing repair, maintenance and improvement is looking at repair, maintenance and improvement on the social housing stock, and demand is clearly very strong there because of cladding remediation. But we've had to revise down our forecast there for growth because despite the fact that finance is available from government and despite the fact demand is very high, the problem is the long lead times for essential products. And we're looking at products like pre-coated aluminium and steel that are imported. And that's likely to constrain the extent to which demand can rise. General public housing repairs and maintenance was very subdued last year, despite the fact that private sector clients were perfectly happy with continuing with projects, assuming the site operating procedures were there. Local authorities were a bit more reticent to have activity being done within homes, given concerns about social distancing, but clearly private clients weren't as concerned. Infrastructure demand remains very strong on major projects, but their delays are increasingly becoming an issue, particularly on HS2. And there's considerable frameworks activity as well. So expect infrastructure demand to continue to be very strong. But there is slight concern about some new projects coming through in those regulated sectors. Commercial demand is an interesting one because you will have seen from the previous chart that commercial activity overall is relatively subdued. And if you want me to get into the forecasts of any of the particular subsectors like retail, offices, leisure, then I can do in the questions and answers, but clearly we have limited time here. So I'll just stick overall with the construction forecast for commercial as a whole. But what's interesting in commercial is that as a firm, it really depends which niche of commercial you're in. If you're doing high grade, grade A office space, there is still high demand there because quite a few companies are looking to move from their existing office space as leases end towards smaller, better quality office space that has more space per worker, given that they're expecting fewer workers in the office at any point in time. You're also seeing a situation in which demand for fit-out activity on offices, retail and leisure units is very high because there's conversions and changes in use of traditional commercial developments, and either changing offices space for residential units within urban centres, or if the offices developments and commercial developments generally are slightly on the outskirts of cities, then they're moving towards warehouses, logistics uses as well. So there's lots of fit out activity, changing retail units for use for other retail purposes, and also changing the use from one sector to another. But overall, the sector is still relatively subdued because the majority of the sector is based upon towers projects, particularly within London, and new towers projects are relatively few and far between in the pipeline. There are still a few, but certainly not as many as was there pre-COVID. And the majority of activity on towers projects is based upon activity within London, Manchester, Birmingham on projects that were signed up to or started pre-COVID. So as they finish, there's relatively few projects replacing them. And that's why activity is relatively subdued overall in the sector. Industrial demand is very strong on warehouses. As you can imagine, the lower demand on new retail, because there's been a shift towards online spending, means that it skews construction demand away from in-store retail and towards warehouses construction. And the warehouses are not just increasing in number, but are increasing in value as you move away from warehouses just being broadly a big shed over towards warehouses that are more the large Amazon style that have a lot of technology in there. So they're increasing in size, increasing in number, and increasing in value as well. But there are delays on this activity coming through. Many of the contractors working on these projects are experiencing supply issues, both on the product side, but also on the labor side. So if we move on to the next slide, and I won't spend much time on this because we're clearly in November, but this is our forecast overall for 2021. And it highlights the difference between our summer forecast and autumn forecast. The summer forecast in green and the autumn forecast in blue-grey. And there's a slight upgrade overall for total construction, which is on the right-hand side, from 13.7% growth this year up to 14.3% growth overall we're expecting for this year, which clearly is very strong growth, but it's coming from the low base last year, having been hit by the initial lockdown, obviously. The strongest rates of growth we're anticipating will occur in infrastructure, driven by those major projects, which is expected to grow by 24% this year. We're expecting private housing repair, maintenance and improvement to grow by 20% this year. And we're also expecting strong double-digit growth in new house building, both public housing and private housing, in addition to industrial. But what I should highlight is the revision up for private housing RM&I from 16% to 20% mainly reflects a change in profile. So if you take this year and next year, we haven't actually changed private housing RM&I. But what we're saying is that we're likely to see stronger growth this year, and then next year activity remain at a high level, but it will be constrained in terms of its ability to grow. And then on industrial, we still have strong growth of 15%, but that's significantly lower than we were expecting in the summer. And again, nothing's changed on the demand side there. The projects are there in terms of warehouses driving growth, but delays on these projects are hindering things. Okay, if we move to the next slide, what we're seeing for next year, in the summer we were expecting 6.3% growth overall for total construction output next year, but we've revised that down to 4.8% growth. So it's still strong growth, and activity will overall for construction will be higher than pre-COVID levels, but we revised down the growth for two reasons. Firstly, the ability of industry to supply everything that is needed for demand, and then in some areas like private housing RM&I, you notice has been revised down from 3% to flat, and then on the new house building side, we've revised that double-digit growth for public housing down to 7%, and on private housing from 8% to 6%. Slight revisions down, but significant nonetheless, mainly due to concerns about the extent to which activity is likely to grow, given the concerns on the affordability side for new house building, and then on private housing RM&I, whether you're going to see that extent of growth that we were expecting in the summer, given that projects are likely to cost more, households are likely to be impacted by rising inflation, and the consumer confidence is likely to be lower as well. But it is still strong growth next year, largely driven by infrastructure, which we're expecting to grow 10% beyond the 24% this year. Again, driven by the major projects, we're expecting industrial to grow quicker next year than we were expecting, as those delayed projects actually get on site and finish. And we're still expecting growth within the majority of other sectors as well. But it's worth just having a couple of minutes on some of our key risks on the next slide. And when I said right at the start, I don't remember a time at which demand was relatively high, and yet there were so many risks out there. It's worth highlighting the different risks. So the first bullet point highlights imported construction products cost and availability. We began to see availability and cost issues for imported construction products like timber, plastics and polymers, copper, aluminium, steel, paints, resins, roofing and cladding materials in autumn last year. So once construction activity had returned back to site, we had the pent-up demand from the initial lockdown combined with the normal level of construction activity. And it's not only UK construction activity that's recovered quickly, but global construction activity has recovered quickly. So those globally traded construction products are an issue in terms of availability and cost. And that's been exacerbated by delays at ports, not just UK ports, where there are around 4 to 6 days worth of delays, but ports in Europe are facing delays, particularly Rotterdam, which is the second, it's the biggest port within Europe, and global ports as well, particularly in China, where COVID outbreaks have caused delays. And the country that we import the most construction products from is China, and there have been delays in products coming in from China, but also sharp rises in shipping costs as well. The cost of a 40-foot container coming from China to Northern Europe was $1,500 last summer, in summer 2020. That's now risen to $14,700, so it's almost a tenfold increase. The shipping cost clearly isn't the majority of the cost of the products, but it exacerbates cost issues there. Timber issues appear to be easing, as do issues on plastics and polymers, but issues over copper, aluminium, steel, roofing materials and cladding materials are still an issue. Combine that with the third bullet point, which is that since spring this year, some heavy side products that are made domestically in the UK, such as bricks, cement and roofing products, are tight in supply as well. The HGV driver shortage continues to affect manufacturers and merchants, and this exacerbates the supply issues. And what some manufacturers are finding is that the product supply directly is not such an issue, and they have stock on their yards, but actually getting that on site is difficult because of that HGV driver shortage. And there's a shortage of 100,000 HGV drivers across the UK economy, across all sectors. But the problem when there's a shortage is that sectors start poaching from each other. And Amazon and the supermarkets can pay much higher than product manufacturing and merchants can. And so manufacturers and merchants are finding that HGV drivers are moving into the supermarkets and Amazon sector, where they can get an extra 5-10K instantly by signing on. The next bullet point is going to be an increasing issue over the next 6 months, which is the impact of the energy cost rises. And there have been sharp energy cost rises over the last few months, and energy cost rises are going to rise over the next 3 to 6 months. And that will impact the heavy side manufacturers producing bricks, cement, glass, steel here. And also, because it's a global issue, that will impact upon Chinese production and exports and costs of steel, copper, aluminium as well. And what the big impact here is due to the fact that energy cost rises for heavy side product manufacturers. Energy costs account for 1/3 of total costs. So manufacturers won't be able to absorb these. They will have to pass them on, which means further cost inflation. And so the key concern from all these issues for us is what's going to be the impact of all these rising costs on specialist subcontractor margins, particularly those firms that are working on fixed price contracts that they signed up to 12 to 24 months ago. And if we move to the next slide, just as a final point, this illustrates the current issues on construction labor and materials inflation. In the 3 months to July, building materials inflation was 15% higher than a year ago. Construction wage inflation was 11% higher than a year ago. And building materials inflation from July onwards is only going to increase further because of the supply issues combined with the impacts of the energy costs. And if we move to the final slide, then this illustrates the extent of energy price rises that manufacturers will face, which is effectively that 3 to 4-fold increase. And they won't be able to absorb those. So if you move to the next slide, then I've provided my details here just in case you don't get time to ask any questions. But what I would like to say is that we do forecasts for 30 different construction sectors. I can only, given the time constraints, highlight the forecasts at the top level, but our forecasts cover 30 different construction sectors and subsectors. And we obviously have a forecast for the UK economy, and it's a 100+ page document that you can get from BBA or contact me directly. But feel free to email me or contact me on Twitter, and I do tend to post the latest data as it comes out as well. Peter, back to you.
Noble, thank you so much. Really interesting, some interesting figures, and to see what happens next year will be slightly worrying but fascinating nonetheless to see how things pan out. And one question I have as we were going through that is next year, obviously this pandemic's been going on, and we've had various restrictions at various times in 21 and 2020. In 2022, if there was a second set or a third set of restrictions put upon us, do you think we could cope better with those restrictions, or would it look fairly similar?
So it's a good question. We're not anticipating any further lockdowns, national lockdowns certainly. If we were to face social distancing restrictions, it would likely to be during a winter period, given that we've got a seasonal virus. I'll take it initially from the construction point of view and then take it to the UK economy, because it's worth distinguishing between the two. From the construction point of view, activity was hit at the end of March as sites were closing, and then in April. But as we got back into May, June time, activity got back to site. So the site operating procedures seemed to work very well in most sectors and enabled construction activity to largely go unhindered throughout the second and third lockdowns. So if we were to face significant social distancing restrictions again, which we're not anticipating, then construction would be able to continue largely unhindered. The one particular area, or maybe two, that may be impacted is commercial towers, where you've got quite a few different trades working within a small area, particularly when they have to go up in lifts as well. So you may see productivity fall in that area. And then where local authorities are signing off work, if there's social distancing restrictions, local authorities tend to be a bit more careful about signing off on contractors doing activity, particularly within homes, as opposed to private sector, which tends to be, you would expect, given it needs to make a rate of return and it doesn't want more cost, it has more of an incentive to crack on with activity. From the economy perspective, manufacturing has found ways of operating during the second and third lockdowns as well. They found safe ways of working. Merchants have also found safe ways of working, builders merchants, in terms of click and collect, click and deliver. That may be hindered by the lack of HGV drivers, but other than that, they've managed to find ways of working during the second and third national lockdowns, especially as the social distancing restrictions didn't affect them, as they were considered essential retail. The bigger concerns from an economy point of view will not be in our areas. They'll clearly be in the areas that have been most affected by social distancing restrictions so far. So you're looking at travel and tourism, and then cafes, bars, restaurants, and in-store retail. So retail, leisure, and accommodation, food, and travel and tourism, which there is they can mitigate some of the impacts due to delivery, click and collect, but they would still be affected very badly by social distancing restrictions.
Excellent. I know we're slightly short on time, so one thing I will say is that the contact details are on the screen. What we do after these webinars, we publish the recording on the BBA website, and I'll put your contact details on that page, so if people want to get in touch and have that detail that you were mentioning before, they can do, if you don't mind.
Yeah.
One thing that I liked you just said then is I think you were talking about independent merchants, and it goes for construction in general, in my mind, that manage to find ways of working it out and getting things done. And I think that's really a good way of summarising the construction industry at the moment. One final question, if you don't mind, Noble.
Yeah.
And I don't know if you'll be able to answer this, but you've got England, Scotland, Wales, Northern Ireland. Is there various different projections per country, or are they all tracking similarly? What's your thoughts on that?
We only do forecasts for Great Britain because the ONS's construction output is for Great Britain, so they give the historic data. We forecast forward based upon that, which is good for us because England, Scotland, Wales will largely track in a similar way going forward, depending on the construction sector. Northern Ireland will be slightly different going forward because A, it's very closely linked to the Republic, and B, with recent events of the last few years, we've effectively put a sea border there. So reinforcing that Northern Ireland to Ireland relationship. And so you're likely to see the Northern Irish market track the Republic market a lot more closely going forward. So I'm glad I don't do Northern Ireland forecasts at the moment. But it is just worth pointing as a general point from what I've been highlighting in the forecasts. The key risks revolve around, obviously, the cost and availability of both labour and products. It's a very different experience between the major house builders / major contractors and the small and medium-sized firms. The major house builders, major contractors have a greater visibility of demand going forward because working on bigger developments or bigger projects. And so they know what they're going to be doing in the next 6 to 9 months. So they can plan and purchase in advance products, and they have greater stability on labour. The SME end of the market is much greater exposed to the risks around product supply and labour supply. And what you tend to find is that the SMEs, particularly the smallest contractors, are the ones who are turning up at the builders merchants on the day to buy what they need for that day or the next few days, which means if there are availability issues, and as there are construction cost inflation issues, they're more exposed to those risks. And that's exacerbated by the fact that the bigger contractors and house builders tend to be the bigger customers of the merchants and the manufacturers, so tend to get priority as well.
Interesting. Well, finally, I'd just like to thank you so much for your time. It's been a bit of an extended webinar, but fully needed and recognised. And thank you so much for your time, Noble, once again.
Thank you.
Okay, so just to summarise, everybody that's been on the webinar, thank you so much for joining me. Thanks to Noble, thanks for the BBA for putting these webinars on. Hopefully we'll see you next week. And if we don't, then have a good rest of your week and hopefully see you soon.